Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode we're talking about bank stock valuations, the outlook for bank fundamentals and M&A activity, and what catalysts there could be for the group. Coming back on the show to talk about all of that is Anton Schutz, president at Mendon Capital. Anton, thanks for being on the show.
Always a pleasure.
Anton, it's really timely. We're talking now on Friday, December 15th. Clearly one of the catalysts seems to be rates and the idea that the Fed has put out the pivot many people have been hoping for, and we've seen the group rip higher on that. One of the things we have seen is that less rate-sensitive franchises have commanded higher multiples. I'm kind of wondering, I understand that with the idea that, okay, if we're in a higher for longer environment, there's going to be possibly more margin pressure, so we want to own who might not face that. And if we've got a pivot potentially coming, we feel better about the group broadly. Were you surprised by the move that we've seen the last couple days where you've seen a lot of names and the group broadly rip up 10, 15% in the last few days since the Fed news? Or do you think it is as simple as that rates, both on the funding side and the credit side, which we can get to later, have been driving so much of the conversation?
Yeah, I think a lot of the conversation and the pricing activity has really been driven by macro traders. And unfortunately, they just seem to want to correlate everything back to 2007. And so what that means is they see doom and gloom and the end of the banking system as it is, when those institutions that failed this spring really had very different challenges and deposit structures. And, mark to market and held to maturity and AOCI are all foreign terms to a lot of these macro traders. All they look at is, oh my gosh, Bank of America has got a huge loss on its held to maturity. Okay, great. But, if their deposits stick around, which obviously they are, it's not an issue. Time heals all wounds anyway. And obviously, because the way those guys trade, any rally in the bonds and rates falling means they're covering shorts in the banking space, which then, of course, causes losses for other people who are short, which causes stop losses and so on and so on. And so you've seen a lot of, systematic guys in here trading these things, and, they cause a lot of pain. I would also say the dedicated people in the space have unfortunately seen, either outflows or not any new money when really the money should have come into the dedicated space. So stock pickers can be stock pickers because there were some absurd opportunities out here from a valuation perspective.
Sure. I'd seen plenty of notes in the last few weeks, even with bouncing kind of off the bottom of October, that multiples were where we hadn't seen since almost March 09, to your point about thinking of 07. I mean, that seemed kind of crazy to me.
Yeah. Well, I mean, you think about it, capital these companies have is very different than 2007, right? The CECL and other loan loss reserves, I mean, at plus capital means a lot. Obviously, we are going to continue to see AOCI marks reverse as time goes on, and that builds capital. And one of the things you're actually seeing now is the resumption of buyback announcements, right? We've seen several the last few days as capital has strengthened, and credit quality again has been, so the macro guys are trading these names on credit quality as well, and they're terrified of office and commercial real estate. And when they're looking at ratios, kind of forget, especially the smaller banks, that if they have commercial real estate exposure, it's to a 2-story building full of dentists.
Right.
Those guys are not deciding not to come back to work.
It's not an RTO discussion. They have to be there.
Yeah. So, if you underwrote these loans at, 60% loan to value, okay, rates are higher. But the other mistake that I think the shorts are making is that they assume that all these loans reprice immediately. And if you kind of look at the time, I mean, you basically probably have 5 years before they all reprice. So where are rates, over the next 5 years? Well, I mean, look, I expect some periods of time where it'll be lower again and refis will happen, or as things mature, the rates aren't really egregious, to those paying the rents.
Mm-hmm. On the buyback piece, and I know that's going to be case specific, but we hadn't seen as many, and a lot of people seemed like they were kind of wait and see. Do you think some of that is driven by maybe more clarity on rates. And I don't even necessarily mean this week, just the idea that we know we're not going to go higher now. This week probably affirmed that, right? That we know the world we're operating in. And maybe also, and this is me hypothesizing, that we've gotten a few more quarters where credit hasn't absolutely blown up. That, to your point, that this probably is a lot slower rather than just flipping on a switch, that each day we pass where we go, okay, we know the world we're operating in. We know the capital is here. Is it just that clarity that gives management teams confidence, that and valuation, I guess?
Well, I think it's also regulators. The regulators generally have not wanted banks to buy back stock, right? Because they're terrified. I mean, if you think about it, they all had, egg on their face from the failures. And, how did they not see this coming? And obviously you want to stop banks from failing. You work on things like capital levels, and you want as much capital as possible to ensure that the industry stays healthy. And the other thing the regulators have not done is they haven't failed the really small banks that might actually have negative tangible equity. They're probably not public companies, and they've kind of given them time. I think, so on one hand, I'm critical of the regulators. On the other hand, I'm going, all right, it's interesting that they're letting some of these smaller institutions kind of let time heal it. As you might be deposit rich, you bought a bunch of bonds, and now your bonds are underwater. We will see more M&A there. I think we're starting to see some reasonably priced transactions as time goes on. We obviously saw the equity bank deal the other day. That was, very strong for equity shareholders. We're seeing some MOE type of transactions where the marks are huge, but the earnings accretion is also, huge. So, it's accounting, but, it all kind of makes sense. And I think the lower rates are, the more we're going to see those transactions actually happen.
Sure. And I want to pick up on the mark piece in a second, but on the MOE one, I've been saying 6 months ago, I feel like when you were at our event in May, we even talked about this, that it felt like we could see a scenario, call it 10 years ago in 13, where the dust cleared from GFC, people kind of knew what people were worth, and valuations were low, and you go, we come together, we cut costs, we ride the wave up. It feels to me like the table could be set for a similar thing here. And do you agree with that? Do you see more of those transactions coming?
Yeah, I mean, I do agree with it because it just creates, stronger franchises. I mean, I think there's a real technology deficit out there, right? I mean, banks have had to change the way they do business and the way they communicate with their customers. And if you need to invest in that, it's sort of teaming up with another institution and, having a bigger budget to be able to pull that off.
Mm-hmm. Mm-hmm. On the mark piece, and I saw you put a comment out on LinkedIn on this and loved it. The idea of rates going down, it's the number one thing when we talk to our friends in investment banking land that stops the deal, that we think it makes sense, but it's so punitive. If I've got to mark this bond portfolio down 13 to 15% and maybe the loan 3 to 5, maybe I have little capital or maybe I have no capital left in the target. Do you think, and I know this has been a very swift move, but as we've seen intermediate rates come down, those marks look far better.
Yes.
Do you think that conversations are almost immediately starting up? I know they've been ongoing and we've seen them, but does that suddenly go, wait a minute, the thing that I thought about doing that I couldn't do now actually works? Does that get boards going pretty quickly?
Yeah, I think it does. I mean, I think that people have held hands for a while and, courted and, so now it can kind of get a little more serious, that courtship. So I do think that we will see more transactions. Obviously, we see the relief rally in bonds continue, certainly more. Clarity from a credit perspective, it would be helpful, right? The economy is still a question mark. There's no doubt about it. Everybody talks soft landing, but there are things out there that are worrisome. I think the subprime consumer is worrisome. I think any of the stats you see there, people are sort of run out of savings. They're spending it on credit cards, or now they're spending it in buy now, pay later type companies. And that's really it's a sign, right? There's a canary in the coal mine that part of the population isn't spending the same. I'll tell you the other canary in the coal mine. I mean, you start thinking about restaurants and travel, and there's a lot less spending there. Seats are now available. All of a sudden I'm getting upgraded on my flights. Where earlier on, if you wanted to sit in business class, you had to buy it. And, there are now seats. And I think that's really, really helpful in terms of just sort of seeing the landscape. One of the things I've always been saying is I don't understand how the Fed, which is a major regulator of the banking industry, doesn't seem to understand that every bank management will tell you that loan growth is much, much slower. Expect flat to mid-single digits. And there it is, right? You can't worry about an overheating economy when you've got all of that very clearly on the table, that demand is less, credit is tighter as well. I mean, it's both. Banks are just going, nope, not gonna stretch, and there's just less demand for loans. Even in parts of the country that have had good growth, there's just less of it.
And we've seen that. I mean, to your point, we've seen tightening standards for the last few senior loan officer surveys, and you saw loan growth come in pretty soft broadly in Q3, and the H8 data is not showing any real pickup. And I think your point there is, look, you've done the job. You're slowing things, right? And the economy's not cratering. It looks like it's being resilient, and the consumer has remained resilient thus far. But clearly, it's slower.
Yeah. No, there's no doubt about it. I mean, honestly, I think the Fed has actually gone too far, and the fact that they're shrinking the money supply through all the quantitative tightening, and then you have the U.S. government running giant deficits, so they're issuing tons of credit as well, which again is reducing the money supply out there to lend and deposit. So I think there's a two-barreled approach between the Fed and the U.S. government that is putting a lot of pressure on liquidity out there, and honestly, if I were the Fed, I would stop selling those securities.
Right. Yeah. And to your point about the government doing it too, it's almost another form of QT to fund that deficit, another form of QT. On the liquidity piece, we've been hearing banks for some time talk about stabilizing. We've been kind of joking, we wonder if they know what that definition means, and saying, well, sure, it feels really stable compared to Q1, but you're still seeing funds shift into higher cost deposits. You've seen deposits decline 6 quarters in a row in terms of non-brokered. The only thing really growing is brokered. How do you look at the liquidity situation for banks today? We know regulators are putting lots of pressure on them. Do you think that we're getting to a point where we're starting to kind of hit that peak in terms of the shift? What are you hearing from bank management teams in terms of their deposit business?
Sure. I mean, I certainly think that the outflow of funds has slowed. I know that, one of my favorite quotes is figures don't lie, liars figure, and the media is shouting from the rooftops that the big banks have taken all the deposits of the smaller banks. No, they took the deposits of Silicon Valley and First Republic, and they certainly took some deposits from PacWest and Western Alliance, but and Signature. But at the end of the day, banks underneath there kind of kept their deposits. The structure kind of changed. And because the structure changed, you've got higher cost funding. And look, that makes sense. At this stage in the cycle, it just makes a ton of sense that type of funding is going to get more expensive. People sort of look around and their neighbor's getting 5%. And, why not? I want 5% also. So that's out there. Money market funds are yielding close to 5.5%. Why not go get that if you've got excess liquidity? So, it makes sense. Look, transactional accounts make a lot of sense to have greater insurance. I mean, I can't believe that there wasn't a change in the insurance for transactional accounts, maybe unlimited. At the very least, the $250,000 number should be adjusted for inflation. It should change every year. It should just get bigger. So if you inflation adjust that number, what is it? 750?
Right. Well, and I've heard that number, since the last time. That's right. It should be 750, which is a massive swing. You would see uninsured deposits drop from 42% to, I don't know where the number goes, but it goes way lower than that. Exactly.
So, that seems pretty logical. I mean, nobody appears worried today, right? We haven't seen any bank runs, and but I'm still really disappointed that nobody got prosecuted. I really am, because I believe in 48 of the states it is illegal to cause a bank run, and of course it's legal in California. Shocker that they did that, but obviously 2 big failures, right?
huge damage to the system as a result,
Yeah.
and
Yeah.
a blow to confidence that I think. Let's hope it's fleeting, but we're not quite fully out there yet. I mean, I do think it's stabilized. And the other point, it woke up the depositor. I mean, that's one of the things that I worry about, that stabilization comment. To your point about your neighbor, we're talking about a large portion of the population who's never been able to earn anything on their bank account because it wasn't there for 15 years, and now it's here. And I kind of don't know that goes away immediately.
No, not immediately. They'll get lazy again when rates come down, and the money will just accumulate, because they're like, why bother, right? But yeah, the money's not lazy right now. The money's on the move, and it'll be on the move for a while. Things like Fed now are really interesting, but careful what you wish for, right? I mean, if you think about companies going back to the financial crisis, right? I think $4 billion left sovereign over a weekend. Boom, it's gone. Goes to Santander. $16 billion left in Wachovia, and boom, that goes to Wells Fargo or Citi First. These numbers are far, far bigger, right? When you look at the amount of money that left that quickly through social media at Silicon Valley or Signature, that's a problem. And you want to make the payment system even faster. I mean, I don't think you need to. This was pretty fast. So, what are you competing with? Crypto? I still think crypto is pretty clunky. I'm still not convinced that it's a great payment tool, but except for criminals.
Pretty effective for that, but I'm with you on that. And one other thing that we've been thinking about on this liquidity piece is the idea that not only are regulators saying be liquid, but you're hearing talk about maybe we should reduce access to things like FHLB, and that's very much proposal, and I'm not saying it makes any sense, but the two things together, I just feel like keeps deposit competition here, even with a little bit of a pivot from the Fed.
Yeah, I mean, look, FHLB or any of the Fed funding sources are important sources, and you don't want banks to fail. If they have good collateral, they should be able to use it, right? I mean, at the end of the day, that's an important thing. Now, look, FHLB would not have saved Silicon Valley, right? Nothing would have saved them, given the amount of money that flowed out and given the amount of money that was waiting to flow out, right? That got halted. That wouldn't have saved it, right? Now, I'm not sure, again, it would have, with the proper collateral, would have hurt the FHLB system either. I do think Signature might actually be here today had they had access. And at least from what I understand, they didn't have access. And, that's a bad thing. Why didn't they have access? Because the FHLB ran out of money. I mean, think about that, right? I believe the following Monday, they issued $87 billion worth of bonds. But they ran out of money. And so they weren't there to help a company in need. And I'm not sure they necessarily should have failed. But, you get a quick run like that, you don't have access to emergency funding, and you have proper collateral, right? Assuming they had the proper collateral, which none of us actually know from the inside, it's really a shame. I mean, to wipe out an entire company, to wipe out all the employees' options, wipe out, lots of people who lost money there. And and by the way, the FDIC lost money. So why are the regulators wanting to lose more money and have more failures happen unless, like I said, as long as there's adequate amount of coverage, why shouldn't they have access to that system? It just makes no sense.
One of the pieces on the collateral that you would pledge, sort of pivoting to that, the collateral is underwater, as we discussed earlier, but it looks better now because of what's happened to rates.
Yeah.
And we've seen a flurry of bond portfolio restructurings in Q4, flurry at 10 to 15. But there was lots of talk, and you hadn't seen but a few trickle out. And usually it was, we've got an insurance brokerage business to sell or something like that to record a big gain to offset it. But now it feels like you're starting to see more that are just sort of fine-tuning. What do you think with rates moving? Do you think you see more? Would you like to see more in terms of banks you own? Or do you think with rates moving, does that mean we can wait this out a little bit more?
Well, I mean, it really depends on the institution, right? It depends on their capital and their liquidity. But to me, if you have some short-term bonds, right, really quick earn back, and get rid of, something that yields 2% and you can get 5% plus, why not? As long as the earn back is pretty quick. But the other thing is if you're getting that 5% plus, you're getting it in overnight funds, right? Your liquidity has dramatically improved and your earnings have improved. And again, it's all about present value and your earn back. But so I'm okay from a gradual perspective in selling short-term securities and having a quicker earn back. Restructure the whole thing and buy more bonds? No, I do not want to see that. Look, we all understand the math. The present value of that math is the same, other than the brokerage commissions. So, careful you're getting your advice from, I think, sometimes. But, I absolutely, as a shareholder, I love more liquidity, right? If you could sit there and go, I've got a $9 billion balance sheet and it's now $8.5 billion and my earnings have gone up and my liquidity profile's gotten better and my capital ratios are better, hey, that's a trade I like. I don't know. I think Nicolay, did that right in the height of everything. But, that's the kind of transaction that makes a lot of sense.
But you're not in the camp of let's not only sell the lower yielding ones, but maybe redeploy with the idea that, hey, maybe we've got higher yielding stuff and maybe rates fall. And so that's sort of a protection on the downside.
Look, I've never liked banks being bond funds. And, at the end of the day, I like banks being lenders. So again, if you've got better liquidity and you can, over time deploy that liquidity into your loans, great. That's what I want to see you do as a bank. If you're trading sub 10 times earnings, you're trading sub book value, yeah, buy your stock back. Shrink your balance sheet, use that capital to buy your stock back. Look, not everybody has an insurance agency, but those are smart things. If you look at the math on those things, kudos to those that had those insurance agencies and capitalized on them.
Sure. Sell at a great multiple and are able to redeploy it back in a business that's trading at a fraction of that.
Correct.
In closing, what do you want to own right now? It's going to be case specific, of course, and you've been in this space a long time, so I know you've got favorites and stuff for sure. But what looks really attractive as we sit here today with peak in rates, maybe a pivot, and maybe some broad money kind of coming back in the group? What looks interesting to you?
Well, look, one of my favorite words, and you've probably heard me say it many times, is optionality. So I like banks that have an attractive franchise that could pivot, right? Be a buyer or seller or MOE candidate. I mentioned earlier, you look at, Brad Elliott and Equity Bank, and you look at what they've accomplished. You look at the opportunities that might be out there for a Hoppy Cole, or Business First. Those are real opportunities to make acquisitions. Hoppy likes to call them pound puppies, but these little companies that might actually, as we talked before, be great deposit franchises, but may have an ugly bond portfolio. And again, you can take that funding, you can market, create a lot of EPS and franchise accretion by doing that. So, I do like the consolidators that have attractive franchises. You can wake up one morning either way, right? See a transaction, they're a buyer, they're a seller, and management teams that have done this before. So, if you look at my portfolio, I've got a real collection of those kind of companies.
And to your point about, and you had mentioned it now twice, you mentioned it earlier as well, but to your point about you've got a lot of small banks out there, close to 50 with negative TC, almost completely because of their bond portfolio being upside down, and they might be in a decent size town, not a big metro market.
Yeah.
They've got a 100-year-old deposit base, and basically it's accounting it is the problem. But if you're 3, 4, 5 billion and they're 500 million, no problem, right? Is that kind of the trade we're talking about here?
I think that's exactly the trade, and you could create a lot of accretion from that transaction, even if it's a cash transaction. If you're issuing stock, fine, if you need the capital, but we're going to see a blend of both, cash and equity, used in these types of transactions. But yeah, it's kind of no brainer. Really the challenge is the selling company understanding they're getting a great currency, that they need to walk away from, we want 2 times book value. How about you look at the paper you're getting and let that paper get the 2 times book value over time? Stronger franchise, again, that doesn't have a technology, deficit from a spending perspective, and actually has some very good prospects, i.e. optionality.
What do you think gets them there? And I should mention to our listeners, too, that you not only have appreciation for the tech spending or lack thereove at some franchises, not only because of your long experience here, but you also have a venture fund, and so you get to look at lots of things on the fintech side and the vendor side. But what do you think, and if you have any thoughts there, please share, but what do you think kind of gets them over the hurdle to do things like that? Just time?
Sadly, it's regulators. So now I'm going on the regulators, maybe on the positive side, as in, maybe they should look at these companies and tell managements, look, you have two options. We could really kind of put the clamps on you, seize you, shut you down, prevent you from doing anything, or you can go find a nice home for yourself on your terms at your pace. I think that could drive more of those transactions to happen. But until the regulators kind of tell those companies, look, go find a home, you're going to kind of have these. I mean, look, I call them zombie banks, right? They're zombie banks. They can't grow their balance sheet. They're just hoping and praying that their bond portfolio improves in value, so the regulators don't show up at their door. But yeah, I mean, having negative tangible equity out there is kind of a scary proposition. And if they could, find a home within reason, they should try to find a home within reason rather than go, we want 2 times book value.
Right. Because that's not coming.
Well, book value is negative, so it's going to tangible. But anyway.
Well, I think that's a great place for us to leave it. Anton, thanks so much for coming on and sharing your thoughts.
Great pleasure as always.